the Chinese impression is that they are willing to at least negotiate, not necessarily on Donald Trump's terms, but to talk. But their impression is that the U.S. has not opened channels and not made an effort to open up channels.
The U.S. is in shock. China, the largest buyer of U.S. oil and gas, suddenly zeroes in on supplies. 90% of oil and 100% of liquefied natural gas disappearing from U.S. export charts. Who takes their place? Canada. Now imagine, Washington spends decades, billions of dollars building pipelines, terminals, developing the shale revolution to become an energy superpower, and overnight loses a key customer. What is it? A trade miscalculation? Or a carefully planned attack?
We shouldn't be surprised with all that's coming out and all the worries about tariffs. It's not just that, it's the complexity of everything else as well. The changes within the federal government, the worries about job losses, the worries about a slowing economy, higher inflation, and eventually you get these what's known as soft data.
What is happening today on the energy front between the US and China is more than just a trade dispute. It is the beginning of a new phase of global confrontation. Beijing is not just withdrawing from the US market, it is hitting the most painful spot, the strategic asset on which the White House has staked in the 21st century, energy exports. And it does so at the most inconvenient moment. The US economy is recovering from a pandemic, oil prices are volatile, and the world's energy markets need predictability. But now there won't be any.
Well, if they did fall on deaf ears, but it's just the latest example in the really day by day, the deepening trade war that is underway between the United States and China. Yes, we are learning that U.S. officials privately behind the scenes urged China to not retaliate. In fact, the Treasury Secretary Scott Bessent has been saying that publicly all along, warning countries to not retaliate. Well, those warnings have fallen on deaf ears, particularly with China, as they raised their tariffs to 125%. The question now is which side is going to blink?
For the first time in a decade, China is openly demonstrating that it is ready to build energy independence from the US. Deals are being signed with Canada, purchases from Russia increasing, and interest in Australian projects is returning. Where does that leave American companies? The European market is overheated and politically unstable. Latin America is already divided between players. Asia is dominated by competitors. And most worryingly, the US itself is increasingly accused of former President Donald Trump. It was his trade policy with tougher tariffs that, according to analysts, provoked the energy split.
In other words, pre-substitution, if we just continue as we are now. But of course, people will start to substitute. They will find other goods. And as the Christmas Tree Association said a moment or two ago, it's going to be very difficult to find substitution of many things that we currently get from China.
But that's not all. According to Bloomberg, China has secretly instructed state-owned companies not to funnel profits to unfriendly countries. That means no oil, no gas from the US at any price level. What's next? China is aggressively investing in infrastructure on Canada's west coast to provide a reliable conduit for heavy oil. Russia offers deep discounts on its grades. Beijing is balancing, picking and choosing and punishing at the same time.
Yeah, you'll be surprised just how much we get exclusively from China. And Jim, I'm really curious to get your perspective on the White House's handling of this situation. Not so much the tariffs that have been announced, but this reporting that the White House, that officials have made clear to Beijing that they want Xi to ask for a call with Trump.
Now the big question, if the US has lost China, can it be compensated? Or are we witnessing a historic turnaround, with Washington losing influence over the global energy market in Canada and Russia sharing its former position? Today, all indications are that the world's energy map is changing, not in America's favor. And it's not just numbers in reports. It's a new distribution of power. And in this redistribution, no one is playing by the old rules anymore. More on that in a moment. In this issue, we'll show you facts, figures, and insights that the authorities won't comment on. You will find out who and why is rewriting the energy map of the planet right now.
Up. You're seeing that swing here going into the afternoon, up almost 650 points. But it was up and down there throughout earlier in the day. With us now, we have CNN business editor-at-large Richard Quest. We have CNN chief national security analyst Jim Sciutto as well. Richard, a key economic gauge, the consumer sentiment now at its second lowest level on record. going back to 1952. Why?
When China appointed Lai Chang'an as its new chief international trade negotiator in early 2023, the world saw it as Beijing's attempt to stabilize relations with the West. But a few months later, it became clear Li had come not to negotiate, but to fight. The escalation of the trade war between the US and China, which seemed to be temporary, turned into a new phase, a cold energy confrontation in which fuel became a weapon and contracts became means of pressure. It all started with Washington imposing record 245% tariffs on Chinese goods. China's response was not long in coming. Hundreds of American companies, including energy giants, for which the Chinese market had been the main export destination since 2016, came under severe restrictions.
There are surveys like the Michigan survey, consumer sentiment, and it's a really worrying number because at some point these sentiment surveys feed into hard data of real consumer spending, and we know this from history and precedent. That's what happens. So when we see a number as bad as this one, it is only a matter of time, unless anything else changes that would suddenly make people more cheerful. Look at that chart. I mean, just look at it. Unless people suddenly become more cheerful, why would this not translate into spending? You see, that consumer lab, the lab from Yale, that number of 4,700, that is providing you don't start substituting goods.
The confrontation quickly went beyond electronics and agriculture. As early as April 2023, Chinese analysts openly declared in closed-door government briefings, "If the US aims to hit our technology, we will hit their oil." It seemed like political rhetoric at the time, but over the summer, the situation changed. Within 3 months, Chinese state-owned companies sharply reduced their purchases of US oil and LNG. In early 2024, the first study by China's Institute of International Energy was published, saying that dependence on US resources was a national security threat. That was the signal. Already in February, China imposed 30% tariffs on liquefied natural gas from the US, and in March completely stopped the execution of new oil contracts. Symbolic was the statement of the head of Sinopec, "America is no longer our partner. It is our strategic risk." On the same day, the US trade representative held an emergency meeting with representatives of Chevron, ExxonMobil and Cheniere Energy. The atmosphere at the meeting, according to participants, was panicked. The US had lost the largest buyer of its oil and gas, without declaring war, without firing a shot, but with devastating consequences.
Right now, 145 going up against 125. These are the tariffs between the world's two biggest economies.
And here's another number, 4,700, or about $400 per month. That is how much more money Yale's now estimating, the Yale Budget Lab, that President Trump's tariffs are going to cost average households each year. And with just hours left in trading, the Dow right now.
And that's when Canada came on the scene. During 2023, Chinese refiners began entering into a series of quiet, almost unnoticed by the media, agreements with Canadian heavy oil suppliers from the western province, Alberta, and British Columbia. Already in April 2024, the volume of Canadian oil imports to China reached a historic high of 920,000 barrels per day, which is 84% higher than the previous year. Bloomberg analysts called it a silent coup in the market. Why did China bet on Canada? The answer lies at the intersection of politics, economics, and strategy. First, heavy oil from Canada's sedimentary basin is a stable resource. Despite high costs, it is cheaper than US oil, especially given logistical problems, sanctions risks, and currency fluctuations. Second, Ottawa has always positioned itself as a reliable, neutral partner, avoiding direct confrontation in world politics. Even despite the diplomatic conflict over Huawei and the arrests of Chinese diplomats, Canada has not severed economic channels. Thirdly, and this is the key point, Canada began investing in infrastructure for exports to Asia. The expansion of the Kitimat port, the construction of the new Trans Mountain oil pipeline, and the launch of the LNG Canada terminal All these projects were frozen in 2020, but unexpectedly received funding in 2023. According to Reuters, some of the funds came from Chinese investors through third countries, including the UAE and Singapore.
Lived in China. You've covered China for some time now. As we're looking at this question of who's going to blink first, with two very different political systems, what is your gauge on this?
Well, different systems, listen, one's a democracy, one is not. One's a single-party state, very much not a democracy. But China does have politics, and Chinese leaders do not want to be seen, we were talking about this yesterday, I believe, do not want to be seen as capitulating to America. That is not good politics for a Chinese leader.
At the same time, it was reported that Beijing has created a special coordination center for diversification of energy supplies, whose task is to fully replace U.S. oil and gas by 2026. The center's reports say it plans to increase imports from Canada to 1.5 million barrels per day and conclude 20-year contracts for the supply of liquefied natural gas from Canada's Pacific coast. At the same time, Chinese refineries have already started adapting their capacities to process heavy Canadian crude, as they were previously designed for light grades from Texas. For Canadian companies, this is the chance they have been waiting for decades. Consortia from Alberta Oil Corporation, Syncrude, and even former U.S. partners have begun urgently modernizing their operations, hiring thousands of new workers and buying out fields previously deemed unprofitable. In Saskatchewan, a new research center, co-financed by China's NIC, was opened to reduce the cost of sandstone production. Economists are already calling this Canada's oil revival.
The more likely it is to have them come into
the higher the tariff, the more you're going to put on the value of that piece, those goods, the higher people are going to pay in shops.
Against this backdrop, the US has become isolated. The loss of China has collapsed the value of export futures, and the reorientation towards Europe and Latin America is slow, competition is fierce, infrastructure is not ready, and political risks outside Asia are high. ExxonMobil and Chevron have already announced the probable freezing of several investment projects in Louisiana and Texas. Small and medium-sized companies, for which the Chinese market accounted for up to 60% of revenue, have been hit hardest. Some of them turned to the state for subsidies, while others filed lawsuits against the US Department of Commerce, accusing the Trump administration of unprofessional escalation of conflict.
But it's also an opening to say, okay, we're capping this for now, and that perhaps offers a way forward that we could begin talking about how to bring these down.
But the important thing isn't even the numbers. The important thing is trust. China no longer has faith in the predictability of the US as a supplier, and Canada believes in China as a solvent and strategically stable buyer. This reversal could change not only trade, but also the global balance of power. While Washington argues about tariffs, Beijing is building a new energy corridor, and Canada is its first point of support. While oil supplies from the US to China were rapidly declining, Beijing was developing a second strike against the US energy industry, this time on the liquefied natural gas market. If in the oil story the main emphasis was on replacing supply sources, in the case of LNG, Beijing decided to use a different tactic: isolation. In early 2024, the Chinese Ministry of Commerce sent a confidential order to major state-owned companies, including Sinopec and Nuke, to temporarily halt purchases of US liquefied natural gas until clarification of trade positions. In the language of diplomacy, this meant one thing: a complete breakdown of relations in this area. Already in May, the number of US LNG contracts sent to China dropped to zero. Containers bound for Asian ports began to turn around in the Pacific. Some of them went to South Korea, others were resold to India, but losses were inevitable. Some companies, such as Tellurian and Venture Global, reported more than $1.2 billion in disrupted shipments.
Well, when you look at the kind of input Musk has been having into politics, there has been some polling done which suggests there is a strong dissatisfaction with.
Against this backdrop, the US tried to build a compensation scheme through Europe, especially against the backdrop of Russia's continued energy pressure. But two problems awaited them there: the high price of American gas and political restrictions. After leaks to the media about wiretapping of telephone conversations between US officials and EU representatives on energy issues, Brussels became more cautious about new contracts. Moreover, fears have grown in Germany and France that supplies from the US are not only fuel but also geopolitical dependence. Many European energy experts openly stated that America trades gas as leverage, not as a partner.
They're doing what they should be doing, perhaps, for the European Union, but it does create ill will. And as you know, we're going to be doing reciprocal tariffs. So whatever they charge us, we're charging them.
China has taken advantage of this. During the summer of 2024, Beijing signed a new package of agreements with Qatar worth over $30 billion for long-term LNG supplies with projects through 2045. This was a real blow to US expectations of regaining share in the Asian market. At the same time, the adjustment of relations with Australia began. Back in 2021, a diplomatic conflict broke out between Beijing and Canberra, and supplies from Australia were cut. But now, against the backdrop of the new configuration, China has proposed a resumption of purchases. As early as August 2024, Chinese tankers began calling at Australian ports, and in September, direct settlement in yuan was resumed.
Including Harley-Davidson motorcycles and Kentucky bourbon. President Trump with the Irish Prime Minister visiting the White House today. The president suggesting his tariffs won't stop here, saying, of course, I'm going to respond. And tonight, right here, the new poll showing 56% of Americans disapprove of President Trump's handling of the economy. The number's even worse now on the president's tariffs. ABC's chief White House correspondent Mary Bruce leading us off.
Today, President Trump side by side in the Oval Office with the head of the Irish government.
At the same time, Canada is rolling out energy infrastructure that had previously been held back for years by environmental protests and bureaucracies. Projects like the Trans Mountain expansion, the LNG Canada terminal, and the renovation of oil storage facilities in Kitimat have suddenly received not only federal approval, but also impressive funding. Some of the money came from private funds linked to Chinese banks, some from Canadian pension organizations counting on stable rents from contracts with Beijing. Inside Canada, this shift is being perceived ambiguously. On the one hand, thousands of new jobs and economic growth in the oil provinces. On the other are concerns about dependence on one giant buyer and the risk of souring relations with Washington. But the Ottawa government has taken a tough stance. These are private deals, and we don't interfere in international trade. Moreover, Canada's energy minister told the CBC, in the 21st century, we don't choose who we sell to. We choose who we build reliable bridges with. This position irritates the US, but Washington is unable to change the situation. Logistics is playing against them. China is investing in modernizing its coastal ports and refineries, making them fully compatible with Canadian and Russian oil. Meanwhile, US companies such as Phillips 66 and Marathon Oil are reporting difficulties in arranging alternative supplies, especially with the congested Panama Canal infrastructure and a shortage of specialized tankers.
To allow that. So now you have the US president say, well, I'm not going to open those channels. China has to open them first. It's kind of ridiculous at the end of the day because you are playing with the interests of American consumers, Chinese consumers, etc. The other point I would make about China's reaction today in not quite meeting the U.S. tariffs, 145% U.S., China goes to 125. And in Xi's statement, he says, we're going to 125 in response. That's as high as we're going because this is getting a little ridiculous, right? And that's both a signal to say we're not going to get caught up in this tit for tat to the degree that the president is.
Against this backdrop, the geopolitical map is gradually being redrawn. Where once the US was able to dictate market conditions, today it is forced to look for opportunities where yesterday there was not even interest. In 2025, the American delegation made a series of visits to Argentina, Colombia, and Mozambique, trying to conclude urgent contracts for LNG and oil supplies. But others, Russia, China, and the UAE, were already waiting for them there, offering more favorable terms, joint investments, and political loyalty. These diplomatic campaigns of the US showed not only the loss of influence, but also weak preparedness to work in the new conditions. ExxonMobil officials complained that in Africa, Chinese companies were buying entire ports rather than oil. thereby closing off access to competitors. In Bolivia, the government rejected an offer from a US oil corporation, prioritizing a Chinese-Iraqi consortium on the grounds of infrastructure compatibility and long-term loyalty. But perhaps most troubling for the US is not China's withdrawal, but the emergence of a new logic of global energy exchange. Whereas oil and gas used to be traded in an open market, more and more contracts are now being negotiated bypassing international platforms. National currencies are being used, joint storage facilities are being created, and Asian banks are being tapped. This is not just a transformation. It is an exit from the old system dominated by dollars and Western traders. Experts are already calling what is happening a quiet energy split. According to them, by 2026 the market will split into two large blocks. The first is the conventional Western bloc, which will include the US, the EU, Japan and Australia. The second is the Eurasian one, led by China, Russia, OPEC countries and Latin America. In between will be the lines of instability, markets like India, Turkey, Indonesia and South Africa, that will choose between the interests of both sides. There are growing voices in the US calling for a policy review. Some senators are proposing temporary tariff cuts in exchange for an energy truce. Others, on the contrary, demand tougher sanctions and greater influence in Latin America, considering what is happening a national security challenge. The White House has yet to give clear signals. In an interview with Fox News, an administration official said, "America has always defended its interests and will protect them in the future." Businesses, however, are waiting for specifics. The loss of the Chinese market has already resulted in 14,000 job cuts in Texas and Louisiana, as well as an 8 to 12% drop in the shares of major energy companies from the beginning of 2025. Investors are worried, and analysts warn that if tensions continue through 2026, the US risks losing access to the world's largest energy market forever. Yet the big question remains: what happens next? Will China return to buying if there is a change of administration in Washington? Will Canada be able to withstand the strain without falling into a diplomatic trap? Will China hold the balance between Russia, OPEC and the West? No one knows. One thing is certain: the energy map of the world will not be the same. And the US, having lost not only its customer base but also its strategic initiative, is forced to play defense for the first time in a long time.